Let's jump right into it. The highly anticipated Michael Jackson biopic didn't just smash expectations at the global box office, it actually triggered a massive, fundamental shift in how we view financial markets. Welcome to this explainer. Today, we're going to completely unpack what we call the MJ effect. We're going to look closely at how music royalties have transformed. They used to be this quirky, niche passion project for industry insiders, right? But now, they've evolved into a massive, heavily data-driven alternative asset class that is catching the attention of Wall Street's biggest players.
So let me pose a wild question that's been bouncing around modern investment circles lately. What do you think is actually more profitable? Owning one whole Bitcoin or owning exactly 1% of a top 10 pop song? I know, it sounds like an incredibly strange comparison right out of the gate. But the reality is, institutional giants are currently pouring literal billions of dollars into that second option. And as we dig into the numbers today, you're going to see exactly why.
Okay, let's start with the catalyst for all of this. The debut of the Michael biopic opened to an absolutely massive global total of $217.4 million. That is a staggering amount of money, for sure. It emphasizes the sheer, undeniable scale of this pop culture event. But here's the catch. If you stop your analysis at ticket sales and popcorn revenue, you are entirely missing the real financial picture. That box office number, that's just the very top of the funnel.
So that begs the question, who are the real winners of a pop culture event of this magnitude? To figure that out, we have to pivot sharply away from those traditional Hollywood metrics. We need to look past the red carpets and the actors and focus on the hidden financial beneficiaries who are operating entirely behind the scenes.
Here is the absolute reality of the situation. The real winners aren't at the box office. They're the institutional funds that own the underlying rights. Think about it from their perspective. For these massive investors, a big-budget Hollywood biopic isn't just a movie. It's practically a globally funded marketing campaign. It acts as a major catalyst to reset the valuation floor for legacy assets. They are literally converting cultural hype into predictable annuity-like cash flows.
And this dynamic creates what industry insiders call the generational handoff. Let's look at the actual data. Within days of the film's release, a 43-year-old track like Billie Jean suddenly hit 3.58 million daily global streams. That is a 63% jump from its baseline. New daily Spotify followers, up over 101%. Monthly listeners, peaked at over 67 million. What's happening here is the event effectively funnels millions of completely new, young listeners into an old catalog, fundamentally refreshing its dollar age. Now, dollar age is simply a metric that measures financial staying power. When you boost the dollar age, you prove to the market that the asset has long-term income stability, and that is exactly what passive income funds are desperately looking for.
We can see this structural transformation most clearly in Sony Music Group's historic acquisition. They swooped in and acquired a 50% stake in the Michael Jackson catalog for somewhere between $600 and $750 million. That implies the entire catalog was valued well over $1 billion. So what was Sony's strategic rationale here? Two words: pure alpha. They secured a non-correlated asset that generates roughly $75 million in total annual yield. Non-correlated is the magic word here. This asset holds its ground even during severe economic downturns. After all, people don't just stop listening to their favorite music because we're in a recession, right?
Okay, so you might be wondering, how on earth are these astronomical multi-million-dollar numbers actually calculated? Well, to understand the mechanics, you have to look at something called NPS, or net publisher share. Conceptually, it's pretty straightforward. It's simply the total royalty revenue collected minus the payouts to the actual songwriters, minus the administrative fees. What's left over is your NPS. It is the absolute foundational metric used by every institution to price these composition rights on the open market.
Once you have that solid NPS number, the market applies a multiple to it, and this is where things get really fascinating. A speculative, newer catalog, something less than 3 years old, only commands a 3x to 5x multiple. Why? Because the hype decays rapidly. But mega catalogs, global icons like Michael Jackson or Queen, they command an astonishing 20x to 30x multiple. Even with rising interest rates throwing the rest of the market into chaos, these evergreen catalogs hold steady simply because their long-term cash flow predictability completely outweighs those macroeconomic headwinds.
But of course, the most advanced funds out there are moving way beyond simple multiples. They use sophisticated discounted cash flow, or DCF models, specifically a rigorous framework known in the industry as Model 3. Here is how it works in 3 steps. First, they forecast cash flows based on the last 12 months.
Second, they apply mathematical revenue stabilization factors based entirely on the song's age. And third, they apply a strict risk-adjusted discount rate to heavily penalize volatility. Think about it. If a catalog's revenue relies on erratic, unpredictable viral TikTok spikes, the model penalizes it. But if it has a flat, incredibly stable revenue line year over year, the model rewards it with a premium valuation.
To truly conceptualize why these massive funds trust older music over today's hottest new hits, we have to borrow a powerful mental model from Swedish investing principles. It's called the Lindy effect. This theory states that for non-perishable things, like an idea, a book, or in this case, a song, the older it is, the longer it is actually expected to survive. So if a song has maintained its cultural relevance for 40 years, we can mathematically expect it to remain relevant for another 40 years. It's kind of mind-blowing, but these legacy IP assets aren't aging in a traditional sense. They are effectively aging in reverse, and that is exactly what makes them a much safer fixed-income alternative than a song released yesterday.
And speaking of a song released yesterday, here is the absolute brutal truth of the modern music industry. 59 days. That is the median half-life of a modern Spotify Top 200 hit. Just let that sink in. A staggering 46% of hit songs have a half-life of less than 50 days before their earnings completely plummet and they fall into absolute obscurity. It's terrifyingly brief.
Now contrast that brutal reality with an evergreen icon. On one side of the spectrum, you have the viral pop hit. It's a fast burner with extremely low durability that decays by over 50% annually. If you buy in at the peak of its hype, you might literally never recover your initial investment. On the other side, you have the evergreen icon. It acts as a permanent annuity, showing a flat or even slightly positive trendline over decades. Avoiding that modern fast burner decay trap is the ultimate secret to succeeding in this asset class.
But look, it's not all easy money. This market has seen some truly spectacular failures. Take the post-hypnosis correction, for example. The Hypnosis Songs Fund was a massive pioneer in the space, but they totally collapsed and eventually required a massive Blackstone bailout. Why did it happen? It was a total cascading failure in due diligence. They relied on aggressively optimistic forecasting, missing their own targets by 23%. They vastly overpaid for catalogs because they completely ignored that decay trap we just talked about, and they severely mismanaged their finances. It proves a vital, absolutely crucial point. This asset class demands rigorous, strictly data-driven management. You cannot just run on personality-driven hype.
Okay, let's close the loop we opened at the very beginning of this explainer, Bitcoin versus music royalties. When we look at risk-adjusted returns, the picture becomes incredibly clear. Bitcoin for sure offers massive absolute returns, but it comes with extreme volatility, a high beta, and a surprising 0.43 correlation to equities. Music royalties, however, offer what we call a superior yield replacement. You're looking at a remarkably consistent 12.6% annualized return. It boasts a massive Sharpe ratio around 2.5 to 3.0, which simply means the return you get is excellent relative to the risk you're taking. And the best part? It has practically zero correlation to the broader stock market. So while Bitcoin is a highly volatile store of value, music provides a contractual, reliable safety net when the broader markets are melting down.
Now, hearing all this, you might be thinking, well, this is great for giant entities like Sony and Blackstone, but what about us? Well, the landscape is shifting rapidly. We are currently witnessing the democratization of intellectual property. Music royalties are actively transitioning away from being this exclusive private equity playground, and they're becoming a broad market alternative that everyday retail investors can actually get their hands on.
This access gap is being closed right now by a new wave of SEC-qualified retail platforms. You have places like Royalty Exchange, which operates a fully transparent auction marketplace. Then there's Songvest, offering Regulation A+ fractional song shares. And you even have platforms like JKBX, which literally allows for micro-ownership of hit tracks. It feels almost exactly like trading stocks on an app. But I have to give you a major word of caution here. The transaction fees on some of these platforms can reach up to 8%. Because of that friction right at the start, you generally need to commit to a minimum 5-year holding period just for the math to beat out a traditional index fund portfolio.
Which brings us to our final thought. As we look ahead toward the 2030 global market, we are facing an internet that is going to be flooded by endlessly generated AI content. The volume is going to be staggering. So in a world of infinite synthetic noise, will a contractual claim on authentic human attention, our deeply enduring emotional connection to legacy IP, and the very sounds of our history become the ultimate, most scarce fixed income asset on the planet? It's a completely fascinating shift in how we fundamentally value culture, and it's definitely something to consider as you build out your own alternative portfolio. Thanks for joining us for this explainer.